80% of Americans rely on just one paycheck. But what if you could create a second or a third or a seventh stream of income that pays you every month without you going to work? No, I'm not talking about a get-rich-quick scheme, unless you're a Nigerian prince. And I'm not talking about doing random surveys on the internet. I just told a toothpaste company about my feelings for 32 cents. I'm talking about real investments that deposit money in your bank account month after month after month while you're sleeping, working, or traveling. And no, you don't need millions of dollars or a finance degree to get started. So let's get right to it. Here are 7 investments that will pay you every single month that you can start using today. Number 1 are covered call ETFs. You can think of an ETF like investing in a basket of stocks. So instead of investing in one company like McDonald's, I can invest in an ETF on the stock market like SPY, which will give me ownership into 500 different companies, one of which is McDonald's. Covered call ETFs work a little bit differently. When I invest in something like SPY, I'm buying this ETF because I want the stocks in this ETF to go up in value. Covered call ETFs are a little bit different because their goal is to produce monthly income for you as opposed to seeing their stock prices going up. I'll give you examples in just a minute, but they do that by doing 2 things. Number 1, the fund manager will work to go out and buy stocks, which is the same as every other ETF. But then as soon as they buy the stock, they're also going to sell call options on that exact same stock. And if you don't know what that means, let me explain. So let's assume the stock is on sale for $100. This fund manager might buy the stock for $100 and then immediately sell an option to somebody to purchase that stock at $105. Now, when somebody buys the option to buy a stock, they're not actually buying the stock, they're just paying a fee to get that option. So now this person, the new buyer of that option, has the ability to buy the stock for $105. And you might say, well, why would anybody do that? Because now let's assume that the stock goes up to $200. Now when the stock goes up to $200, this buyer will buy the stock for $105 because they paid this option fee. Now if the stock goes down to say $50, this buyer is not going to buy the stock because they would lose money. The only thing that they lost is that option fee. So what these covered call ETFs are doing is they're buying stocks for the income for selling these options. Here's a couple examples. JEPI is a covered call ETF created by JP Morgan Chase Bank with the primary goal of creating monthly income. And at the time I'm recording this video, they're paying around an 8% annual dividend. We can compare this covered call ETF, which invests in a broad variety of stocks, with this. QYLD is a NASDAQ 100 covered call ETF, meaning they focus on companies in the NASDAQ. And at the time I'm recording this video, they're paying out an annual dividend of around 11% a year, paid out monthly. You want to pay attention to the underlying assets that these ETFs are investing in, because if markets crash or we go into a recession and these ETFs are not able to sell a lot of these options, well, that means that these ETFs are going to be holding onto those stocks. And if you're holding onto stocks that are a bunch of, well, doo-doo, it's not going to be worth much. And so if you're investing into an ETF that's investing in stocks that you believe in and markets go down, well, hopefully the markets will rebound and you'll see the value of your assets go up as well. So the pros with these types of covered call ETFs are, number 1, you can create monthly income. And number 2, the strategy works even if stocks are moving sideways. The cons are, number 1, if the stock market booms, well, you're not seeing all the upside because remember, you're working for income and you're selling the option to buy the stocks. So even if the stock goes up to $200, you're not seeing all the upside. You're working for the income, which is that option fee. Number 2, if markets crash, the value of your ETF will go down and your income will also go down, which is why, again, the assets that you're investing in are so important. That way, hopefully, you can see the value of your investments rise again. And of course, number 3, you're not FDIC insured because you're investing your money in the stock market. Now, I have to remind you, I'm not telling you what to invest in. I'm just a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And this brings me to number 2, REITs that pay you monthly. A REIT is a real estate investment trust. These are stocks on the stock market that are in the real estate business, and the reason why they're very interesting for income investors is because they have something called the 90% rule, which says that these stocks must distribute at least 90% of their taxable income to investors, which means they're required by law to pay out 90% of the profits to their investors, shareholders, people like you, in the form of dividends, and some of these REITs pay out monthly. The most popular example of this is Realty Income Trust, which has a ticker symbol O. And Realty Income Trust is in the business of investing in retail, industrial, and agricultural real estate with the goal of generating stable cash flow. That way you can get monthly dividends. And at the time of me recording this video, Realty Income Trust is paying out around 5.5% a year in dividends. Example number 2 is Stag Industrial, which has a ticker symbol STAG. This is a REIT that's focused on investing in industrial properties in the United States. And at the time of me recording this video, Stag is paying out around 4% a year in annual dividends, paid out monthly. The pros with investing in a REIT is now you get exposure to the real estate industry without having to operate and manage real estate yourself. And number 2 is you can create the monthly regular cash flow. The cons here are, of course, the risk. There's a risk that real estate will go down. If real estate goes down, well, that can hurt real estate companies. And not just that, the company itself also maintains a risk, because even if real estate is going up and the company is managing their cash badly, they have a bad CEO or they're not growing, well, that can also impact the value of your dividends and the value of your stock. So if this company, the stock, were to go bankrupt, you would lose everything. This is why, again, it is so important for you to look beyond just the dividend that you're getting and make sure that you're investing in good underlying assets. What is the actual thing that these things are buying? Because if things were to go bad, you want to own something that's actually worthwhile owning. And again, if you are an investor or want to become an investor, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in things like the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. And when you join Market Briefs, you'll also get my investing masterclass as a bonus, where I break down how you can get started as an investor and find big investment opportunities before everybody else. This investing masterclass is a bonus that you get for free just for signing up for Market Briefs. So if you want to get all of that for free, I have the link for you down in the description below. The third way to start generating monthly cash flow is by investing in government bonds. The United States government generates money through tax dollars. Now, the interesting thing about this is they spend more money than what they generate. And in order to fund that extra spending, they have to go into debt. Well, one of the ways that they can get that debt is by raising money from regular people like you and me. And now you can lend money to the United States government, and in exchange, you will get paid with interest. Now, the interesting thing about this is the United States government has pretty strong collateral, because their collateral is their taxpayers through tax dollars and the entire United States economy, not to mention that they can work with the Federal Reserve Bank to essentially print money to fund their bills. These loans to the government are called treasuries, and every economist will tell you that these are risk-free investments because the United States government has the ability to always pay their bills, because they can either raise their taxes to pay back your interest, or they can get the money printed from the Federal Reserve Bank. Plus, the other benefit of investing in treasury bonds is you're generally exempt from state and local taxes, which means if you're in a high tax state like California or New York, you generally don't have to pay any state or local taxes on the money and income you make from treasury bonds. Now, there's a couple ways that you can go out and buy these treasury bonds. You can go directly to Treasury Direct and buy them from the United States government, or you can invest in ETFs that give you exposure to these treasury bonds for monthly income and not have to deal with the United States government. For example, SGOV is an ETF that gives you exposure to 0 to 3 month treasury bonds, short-term treasury bonds, and at the time of recording this video, they're paying out a 4.7% annualized dividend that's paid out every single month. And we can compare this ETF that gives you exposure to treasuries that are 3 months or shorter to SHV, which is giving you exposure to treasuries which are 0 to 12 months long, and at the time of me recording this video, it's paying out around a 4.3% annual dividend paid out monthly. Yes, these are regular ETFs that you can buy and sell on pretty much any stock brokerage out there, but they're different than many other stocks because the goal with these is to give you exposure to treasuries. And so what you'll generally see is that these ETFs don't change in price. The only time that they fluctuate in price is when they pay out their monthly dividend. The price will drop by the amount of the dividend, but the value of the stock doesn't change because they're backed by treasuries. So you're buying these for the interest. You're not buying these to see growth in the value of your investment. So when you're investing in these types of funds, you're not FDIC insured because it's not a bank, but it's backed by the United States government. If the United States government were to go bankrupt, well, now you would lose the value here, but because the United States government is the strongest economy in the world, that's probably not very likely. So those interest payments are pretty secure. You're getting a pretty decent interest rate, but you're not seeing any growth in your principal If the Federal Reserve Bank starts cutting interest rates more, well, then you would see the interest rate paid out by these funds drop as well. And yes, even if you buy these, you are still exempt from state and local taxes generally. Option number 4 to create monthly income is to invest in real estate. The way this works is instead of me going out and buying a property like this to live in for myself and my family, I'm buying this, let's call it $200,000 house to rent out to other families. And I know what you're gonna say, Jaspreet, where in the world are you gonna find a nice house for $200,000? Well, if you're in New York or California, you're probably not gonna find it, but if you go down to Michigan, you'll find these types of properties all day and night long. Now, I can rent this property out for $2,000 a month, which means I could generate $24,000 a year from this property. But it's not all profit because I have expenses to pay. I have to pay for my property taxes, my insurance payments, my maintenance fees, my management fees because I don't want to manage this property myself, and I have to factor in some vacancy because it's not going to be rented out every single month for every single year. So let's assume that I have $14,000 worth of expenses for the year. That means I made $10,000 of profit over the year, and yes, this is paid out monthly because those rent checks come in every single month. Now, the interesting thing about real estate is although I have $10,000 worth of profit, I don't have to pay taxes on all $10,000 because as a licensed attorney, who is not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that our tax code has to offer. One of those tax breaks is called depreciation. And what depreciation says is that when your property gets 1 year older, you deserve a tax break. So if we assume in this example that this $200,000 property is $50,000 worth of land and $150,000 worth of the actual house, that would mean that I'm going to get about a $5,400 write-off on paper according to the IRS because my property is 1 year older. This is not an actual loss. This is just what the IRS says that I get to take as a deduction because my property is 1 year older, which means on paper, I get to tell the IRS, I have $4,600 of taxable income, and that's the money I'm gonna pay taxes on. I have $10,000 in the bank. This is my taxable income, which means I get to keep more of my money, pay less of it in taxes, and have the $10,000 in the bank. In case you were wondering, how did I come to that $5,400 number for the depreciation deduction? The way it works for single family home rentals is you take the value of the property, remember it was $150,000, and you divide it by 27.5. Why is it 27.5? Because that's what the IRS says. So the benefits of investing in real estate are number 1, you get to own a hard asset. I get to see, feel, and touch the bricks, the windows, the land, and everything here in the property. Number 2 is you could create that monthly cash flow because when you have a tenant here, well, now the rent comes in every single month. And number 3 is you get some amazing tax breaks as a real estate investor. I'm really just scratching the surface in this video. You can watch some other videos on this channel to see the real benefits of investing in real estate. But the cons with real estate are number 1, it's more work because now you have to actually operate the property. Now, I don't manage any of my rental properties. I have a property manager, but I still have to manage that property. If I were to go out and invest in the McDonald's stock, I don't have to tell the CEO what to do. They have their own management already put into place. I'm just a silent owner in the company. When I invest in real estate, even if I have a property manager, I have to still oversee the property manager, so there's more work. Number 2, it also takes more money because to go out and start investing in real estate, I need capital to go out and do it. Now sure, I don't need $200,000 to buy a $200,000 property. I could use debt, I can get money from other investors, but you do need more money to get started, and it's gonna take more time. Because when I wanna invest in real estate, well, I have to find the property, go through the work, and then actually close the deal versus when I buy stocks, I can buy and sell stocks in an instant. The 5th way that you can create monthly income is by investing in real estate funds. And no, I'm not talking about REITs. So remember, a REIT is a real estate investment company, and you're buying shares of that company on the stock market. When you're investing in real estate, you're buying the property yourself, and now you are the investor in the property. And then in the middle, you have the ability to invest in real estate funds. This is where you have somebody who's going out and buying property, and they're redeveloping it, or they're trying to create cash flow from this property, and then you're gonna give this person money. Generally, you will be a silent investor, and in exchange for your investment, you can get regular distributions. Many times they will be monthly, sometimes they'll be quarterly, depending on the arrangement. Now, there's a couple ways to go out and actually invest in these funds. You can find these types of deals in person. Generally, they're called syndicate deals by going to real estate investor conferences in your area. They happen all around the country, and there's always investors and developers that are looking for money. So if you find the developer and you like the deal that they're doing, you can invest in their deal. Sometimes they're going to have a minimum of $5,000 or $50,000 depending on the type of deal, and other times they're going to have much larger minimums. The alternative is to use an online platform where you invest money and get exposure to real estate. One example would be my sponsor Fundrise, where now you can invest money into Fundrise and they will give you exposure to either one or multiple real estate properties or funds, and then you can get paid your share of dividends. The pros, again, are that you're getting exposure to real estate, you can create regular income, and it can be very passive for you because of something like Fundrise. You can create an automatic investment that we're investing every month into your fund, and you don't really have to do anything. You don't have to manage tenants or deal with the properties or anything in between. The cons are, well, there's risk. You're investing in real estate. If the deal goes bankrupt, you could lose your investment. If real estate goes down, you could lose value. And so you have to remember that this is investing, and investing has risks. If you want to see more about Fundrise and see if this is a type of investment that would be interesting for you, I will link them down in the description. That way you can learn more and see if it makes sense for you as an investment. Again, we are a paid partner with Fundrise, so if you use them, we will get compensated, but there's no additional cost to you. The sixth way to generate monthly income is to use a high-yield savings account. A high-yield savings account is a bank account. It's FDIC insured, but it generally doesn't have a physical presence. So it's not like JP Morgan Chase Bank or Bank of America that you can just walk in. These are generally internet banks, but the advantage here is they can generally pay you much higher interest rates on your savings. At the time of me recording this video, they're paying out between 4 to 5% a year in interest on your savings. But the interesting thing about this is that about 80% of America is not using a high-yield savings account. The average bank account in America is paying out an interest rate of less than 1%. It's actually closer to 0.5%. But if you go to a high-yield savings account today, right now they're paying somewhere between 4 to 5% a year in interest. Again, it's a regular bank. It's FDIC insured, and it can pay you that interest monthly deposited into your account. So if you have some extra savings, you might want to consider moving that money into a high-yield savings account. Again, do your research, make sure it's a legitimate bank, make sure it's not some sketchy, scammy place that you've never heard of before. There are a lot of legitimate places out there that you can put your money and get access to it whenever you want virtually, and at least are generating some interest on this. Now the cons here are if the Federal Reserve Bank starts cutting interest rate, your interest rate on your savings would also fall, and you're not seeing any growth in the principal of your account, you're just getting the interest. So again, it's not really a way to beat inflation and get rich, but it's a way to at least get some interest on the extra savings that you have. And the seventh and most difficult way to generate this monthly cash flow, this monthly income, is to own a business. I've given this example in a previous video and I'll do it again here. I own a company called Briefs Media. And let's assume that Briefs Media makes $1 million a year in revenue. Well, not all of that money is profit because we have expenses to pay. We have to pay for our team's salaries, we have to pay for rent, we have to pay for softwares, and a whole bunch of other things. So let's assume that we have $600,000 a year in expenses. Well, that's going to leave $400,000 in the bank account at the end of the year. This $400,000 of profit can now be used for three things. Number one, it can be used as emergency savings for the business. Number two, it can be used to reinvest back into the business to grow faster, to get more subscribers, to market briefs and everything else. Or number three, it can be distributed to the shareholders of the company. Now, in this instance, I am the sole owner of Briefs Media. But we also have a unique position because we also offer a profit distribution with our employees. I know a lot of companies don't do that, but for us, we do that. But the reason why I'm making this example is now, as the owner of the business, I am entitled to the profits, and I get to decide what to do with it, which means I could fire myself as a CEO, hire a new CEO that would be paid out of this expense, and those profits would still be coming to me. So if I move to Hawaii and I live on the beach, and the company continues to make money, I keep making my profits, and the CEO is paid out of the expenses because it's a salary. But the reason why I said this is the most difficult is building a business is very hard. Building a business that doesn't rely on you is even harder. And to build a business that's profitable, consistently growing, is going to take a lot of time, a lot of work, and a lot of effort. It's not for everybody. It's not for most people. If you don't want to start a business, but you're really interested in business, you can also consider going out and buying a business. There are many different types of businesses out there. The key piece of advice that I would give you is make sure that it's a business where you can eventually step away from and potentially replace yourself with, because if it requires you, it's really not a business. You just bought yourself another job, and that profit distribution is really just a bonus to your salary. If this is the type of stuff that you're interested in, there's a great book that I recommend you read. It's called Built to Sell. I have no affiliation with them. I just really enjoyed that book and it gave me a lot of insight, and I hope that it'll give you some insight as well. And there you have it. 7 new investments that can create a new income stream to your bank account. If you enjoyed this video, the best thank you that you can give me is by sharing this video with a friend or a colleague, or by sharing it on social media, because my goal is to help spread this financial education with more people. So if you enjoyed it, please spread the word, and thank you so much for watching. If you make $80,000 a year from your job, you need to make $80,000 a year from your investment income to be able to quit your job and live your life without changing anything you're doing. With your job, you have to go into work every single day to keep getting paid. With your investments, once you put your money to work, it'll keep paying.